The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome. It's Friday edition of Schoolbox Europe with Karen Cho, myself, Steve Sedgwick, and these are your headlines. Nearly a week into the war in the Middle East, President Donald Trump says Iran is desperate to strike a deal to end the fighting, something Tehran's top diplomat denies.
They're calling, they're saying, how do we make a deal? I said, you're being a little bit late.
We are not asking for a ceasefire. And we don't see any reason why we should negotiate with the U.S.
The U.S. offers India a 30-day waiver to buy Russian oil as the White House looks to address global supply concerns and rising costs. This as U.S. crude prices see their biggest single-day rise since 2020, passing the $80 mark. Bundesbank President and ECB Governing Council member Joachim Nagel tells CNBC it's too early to tell how hard the war in Iran will hit the European economy, but says the impact is already being felt.
This is a very complicated time. I think this war is not helpful. It is a burden for the economy in Germany, in Europe, and I believe for the whole world.
All right, there's a lot going on. US President Donald Trump says Iran wants a deal, but Washington now wants to fight more than they do as the conflict in the Middle East enters its 7th day. Mr. Trump also said he should be involved in choosing Iran's next leader, telling Axios that the son of the former supreme leader Ayatollah Ali al-Khamenei, who has emerged as a frontrunner in recent days, is an unacceptable choice. The US leader claimed the widespread destruction of Iranian military assets, saying Tehran is a little bit late to try and reach a deal.
We're destroying more of Iran's missiles and drone capability every single hour, knocking them out like nobody thought was possible. As soon as they set off a missile, within 4 minutes, the launcher gets hit. They don't know what's happening. But we have the greatest military anywhere in the world. Their Navy is gone. 24 ships in 3 days. That's a lot of ships. Their anti-aircraft weapons are gone. So they have no air force. They have no air defense. All of their airplanes are gone. Their communications are gone. Missiles are gone. Launches are gone. About 60% and 64% respectively. Other than that, they're doing quite well. I said, what's left? But they're tough, and they want to fight. And they're calling, they're saying, how do we make a deal? I said, you're being a little bit late, and we want to fight now more than they do.
Speaking earlier in the day to NBC's Tom Lamas, Iran's foreign minister dismissed suggestions that Tehran is seeking a deal.
We are not asking for a ceasefire. And we don't see any reason why we should negotiate with the U.S. When we negotiated with them twice, and every time they attacked us at the middle of negotiations. So there is no request for a ceasefire by us, and there is no request for the negotiation with the U.S. From us. We have never sent any messages to them.
Well, there you go. Conflicting views on the conflict. Dan joins us from Dubai. Dan, what is the latest as far as you can see?
Steve, good morning. Well, Iran has launched a fresh wave of drone attacks across the region overnight, and we've also seen the US and Israeli forces continue their strikes on Iran. Here in the Gulf states, we have seen air defenses working overtime and intercepting missiles and drones overnight. In fact, over the UAE last night, as this conflict continues to spread, residents here received emergency alerts on their phones as we saw those intercepts continue to take down more Iranian threats. In Saudi Arabia, air defense defenses as well, also intercepting and destroying 3 ballistic missiles that were headed towards Prince Sultan Air Base, according to state media. And in Qatar, a busy night as well. Authorities there saying missiles and drones were targeting Al Udeid Air Base again. This is the largest US military facility in the Middle East. And in Lebanon, we're also watching developments closely. Israeli forces are now bombing the southern suburbs of Beirut in strikes that they say are targeting Hezbollah. More than 85,000 people have been displaced so far, according to government figures. And as this escalation also continues to disrupt global air travel and energy markets, we're watching the impact for the airlines. We are seeing Emirates and Etihad and Qatar Airways suspending or limiting flights again today as airspace across the region remains restricted. And on the energy front, oil prices actually falling today after the US said it would issue a 30-day waiver allowing Indian refiners to buy Russian oil. Yes, you heard right. Russian oil. So the US Treasury out with a note late yesterday saying they're going to be able to issue licenses that would permit some of these Indian companies to purchase Russian crude and products loaded onto vessels before March 5th. So that means essentially the White House is now attempting to get the flow of oil moving again, given the fact that the Strait of Hormuz is de facto closed at this point. It's part of the reason we've seen oil prices drifting a little lower today, but also fair to point out, prices here for the crude complex actually on track for another strong week. WTI up around 20% so far this week on fears this conflict could also continue to disrupt those critical supplies through the strait. And another take on the situation on the ground. I spoke with the EMA founder Mohammed Al-Abar overnight. You know his name. He's one of the UAE's most prominent property developers, a key voice of business in the United Arab Emirates. He's also a key architect of this city's skyline as well, including icons like the Burj Khalifa and the Dubai Mall too. He told me that the UAE was specifically targeted by those Iranian drones and missiles this week because it is a symbol of peace and prosperity in the region. He also dismissed concerns that this could have a significant impact on the UAE economy and its hot property market. Listen in.
Oh, I'm not concerned for a reason that myself, I'm looking for one building, one apartment overlooking the sea that I didn't buy in. And the past 2 days I've been looking and it seemed like nobody wants to budge, nobody wants to give a discount. Truly, this is a true situation. I'll show you later. But no, I'm not concerned at all. As I told you, we've been growing 70, 40, 30% a year. And again, I mean, a situation like this, you know, there could be a bit of cool down, but I really don't see any. I don't see any issues. Plus, remember, our real estate business is not built on bank borrowing. Bank borrowing is very restricted in this market. Consumer confidence will be shaken a little bit, but as I said, the policies of this country bring your confidence back so fast.
Fitch, the ratings agency, was warning of a 15% correction, and that was before this week. Do you think we will see a significant correction, like 15%?
I know my business well. I know the banking, I know the business environment because I operate in multi-industries. I think the principles of doing business really in the countries are really incredible. The banking system is so strict, amazing discipline. Government policies, they're just getting better and better. I have no concerns.
So this 15% correction is unrealistic, you're saying?
In my opinion, the way I look at my business and listen, I look at so much data, I think it's very unrealistic.
Mohammed Al-Abar speaking to me at his home late last night and reacting to what has been one of the most consequential weeks in this nation's history. Of course, we have also seen shares in the major property developers like Emaar Properties and Aldar Properties limit down through the course of the session yesterday, down by around 5%. We see bond prices for these major developers also dipping, which makes it more expensive for them to raise new capital in the short term. The mood in the real estate industry right now is really a watch and wait approach at the moment. There is a lot of supply coming online and a lot of these projects rely on future payments from international buyers. So a prolonged conflict here could really threaten the funding pipeline for this massive wave of construction that is scheduled to take place between 2026 and 2028. And all eyes are on the property market in particular, given how hard and how fast it has run up over the past few years.
Dan, as you point out, it's been quite a week, and so let's just connect some of the dots. A near 20% spike in the oil price from here. The market worried about the duration of this conflict and what we've seen over the course of the week, spilling across borders, whether it's Turkey, Azerbaijan we're talking about today, whether Gulf states retaliate. Can I also ask you about the Kurdish position? Because overnight, the message from President Trump was that he wanted or was encouraging the Iranian Kurdish forces in Iraq to get involved. Would that mark any change, having sort of a ground force involvement here? Because we know there's reluctance from the Americans to put boots on the ground.
Indeed, and the US president also said earlier this week that he wouldn't rule out putting boots on the ground, but also suggested that it would not be necessary because of the extent of the US and Israeli air force attacks that we've seen inside Iran. And through the course of this week, we have seen Iran's Navy and its air force being significantly degraded. The Pentagon actually saying yesterday that the air force had been eradicated completely. And of course, we also saw those very dramatic images of the Dana Iranian frigate being broken in half and sinking to the bottom of the Indian Ocean off the coast of Sri Lanka as well. So the Iranian forces have taken a significant hit. With regards to the Kurdistan position, of course, this would also be a significant development because it would represent what would be an expansion of this conflict and an expansion of the US ambitions as well. President Trump saying he did not want to see this turn into a forever war, but as we see these individual groups also beginning to get involved, then the concern is that this could run a lot longer than investors initially expected. The duration risk is the biggest unknown at this point, and something that the market is watching very closely.
Yeah, absolutely. Dan, superlative coverage all the time on this one as well. I've got some live news for you as well, for all of us as well. And this is getting really, really serious for a whole lot of people who rely on the Middle East as transit routes and for the commodities as well. Maersk, which is one of the biggest logistics companies on planet Earth, has taken the decision to temporarily suspend the FM1 service. I'll come to this in a moment. Connecting Far East to Middle East, and the ME11 service connecting Middle East to Europe. Both ways, Middle East to Far East, Middle East to Europe as well. So for both sets of customers, that is very serious. The decision to suspend some services has been taken as a precautionary measure to ensure the safety of our personnel and vessels whilst minimising operational disruption across our wider network. It's all very well for the US administration to say, oh, we will ensure shipping, but clearly the shippers and their clients do not feel confident shipping out of that region at the moment. So what is the FM1 service? I didn't know. I'm going to give you some details. The FM1 service is the Far East Middle East 1 service, provides fixed, weekly, direct and swift connections between the major Northeast and Southeast Asian ports and the Arabian Gulf. It utilises a 28-day rotation, deploying vessels of between 3,500 and 8,700 TEU, which is obviously the size of the containers as well, often servicing key hubs such as Tanjung, Salah and the aforementioned Jebel Ali. And Jebel Ali, which is a port I've actually done some pieces to camera from as well, is an enormous port in the UAE. So that is serious ramifications yet again for global supply chains. And have I got time very briefly to talk about the prices of gas on the week, just because a lot of people are very concerned about it. Karen, and you and I were looking at this earlier on. The figures are enormous. We spend a lot of time on oil. Naturally, we do. WTI is up for the week to date, 21%. Brent up 18% for the week to date. But when you look at the gas prices, RBOB up 28% week to date. UK natural gas up 65% week to date. European TTF, all the different measures, up 64% week to date. This is getting serious for the global economy. This is not about just that region. This is about what it means for the supply chain globally.
We heard from Joachim Nagel over at the Bundesbank overnight, and he was talking about being very concerned about the situation, but still watchful. And don't forget, as we move further throughout March, we're getting closer to the next central bank meetings. So we will be hearing more and more from central bankers over the next couple of weeks about the implications.
It takes all chances. This isn't me saying my opinion. This is all the copy that you and I are reading from the great investment banks and the economists. This takes rate cuts off the table. This takes, because the inflationary impact of those commodities I just mentioned, plus a whole host more, and plus the shipping rates, which have got to go around the south of Africa to get to some of these areas. The shipping rates go through the roof, which means the cost of goods, the insurance has gone through the roof, the commodity prices are going through the roof, and it risks, dare I say it, recessionary influences further down the line.
Unfortunately, we're also well versed in this area now, having been through the inflationary cycle that was supply chain. It was second round effects of the oil story that we saw in Europe as well. So from every different angle, we've seen this touch point before on how central banks have to react.
And if the US president is saying this is 4 to 5 weeks, we're only week one in. The market is not taking any chances on this one as well. And extraordinary stuff. Anyway, there's another angle to this story again.
Yeah, let's get to the latest around Azerbaijan, which has vowed to respond after 4 people were injured in what it said was an Iranian drone attack. Iran's deputy foreign minister denied that Tehran had targeted its neighbour. The US crude prices jumped past $80 a barrel on Thursday, and the biggest single daily gain since 2020, amid supply chain disruption fears and claims by Iran that it struck an oil tanker with a missile. US President Donald Trump looked to downplay concerns around spiking natural gas prices, telling Reuters they'll drop very rapidly when this is over. Ahead on the show, February's non-farm payrolls are due out today. We'll tell you what to expect. Plus, US President Donald Trump suggests he might turn his attention to Cuba next after Venezuela and Iran. His comments later this hour. And don't miss our conversation with the CEO of Skanska. That is up at 7:45 GMT.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
The selling resumed stateside yesterday, markets reversing. You can see the ranges, 1.6 down on the Dow, a little bit less coming off the Nasdaq. And don't forget, a day earlier, investors had marched back into some of the technology trades, but it was risk off again. And it's the duration, as Dan was pointing out, around this conflict in the Middle East that markets are concerned about. The rise that was in oil prices that have also triggered about an 18-point rise in Treasury yields. So the market looking at that tightening credit landscape and what it could mean from some of the high growth areas of the market. That said, if you look at some of the sectors over the course of yesterday, it was consumer staples that was hit the most. That real consumer basket down 2.2%. Tech was actually the best performer still. So some resilience on day two, as you could see, as that tech story was brought back. In terms of the Asian markets, what they've weathered this week, it has been the South Korean market that has been under enormous pressure. Very large swings for a couple of sessions before a bounce back that we witnessed yesterday. And today, this is a very different picture again, stable, barely moving. So despite the pendulum that we've had on that Kospi this week, as we looked around out Friday, it looks like it is not moving very much at all. The Japanese stock market up 0.6%. Hong Kong and China also in the green. Well, European futures, as we look to get going here in Europe this morning, we have also had a brutal week to the downside. We've had selling to the tune of 6+% on French stocks, 4.5% on the broader benchmark, the Stock 600. And you can see in the mix, we are seeking some higher territory, looking to claw back some of those losses. Well, in the data mix, we also get February's non-farm payrolls figure later today. It's expected to show new hires falling by more than 50% on the month to just under 60,000, according to economists polled by Reuters. That data hitting the tape at 1:30 London time. Sammy Chard, chief economist and CIO at Switzerland Lombard Odier, joins us. Sammy, just weigh in. It's been such an extraordinary week. What have you been watching and what's your chief concern now?
Well, of course, I mean, trying to have a view on the duration of the conflict and the tension around energy prices is obviously key. In that respect, we oppose the situation today to what we've been through in 2022, right? I mean, the oil prices are around 85 for the Brent. They were at 125 in 2022 when we had Russia and Ukraine. So from there, you can infer a couple of scenarios and what it means for the economy so far. If this is a question of weeks rather than months, and if the oil price peaks at around 85, this is not enough to break the back of the current expansion that we're benefiting from. And this is really, really central to our portfolio positioning today. So are we going to have a recession? Is this going to last months? Are we going to have the oil price above 100? If no, we're probably going to stay in expansion, and that's a reason to remain invested.
Sami, the market reaction, though, at the start of the week versus where we've ended up now at the back end of the week, quite different. It felt as though some traders and investors were going to try and look through the situation on Monday. And by Tuesday, we saw really risk off and some racing for liquidity that's continued over the course of this week. It feels like the market is not buying the dip just yet. What do you make of that cautious sentiment?
True, but I wouldn't say that there is a sense of panic. The selling hasn't been intense. We've given back some of the gains through this year, but we haven't entered a real market correction. It's basically short-term volatility that we're experiencing currently. So the market is not panicking either. And I think it's trying to balance the risk between, okay, this is a $10 oil price shock that is unlikely to have a massive economic impact, or is it going to turn in a $50 oil price shock, which again would be enough to tip this economy into severe slowdown or into recession? And clearly the market hasn't made its mind. It only takes a tweet from Donald Trump to say that he could be satisfied with what had been done so far and that he could de-escalate the situation. And clearly the market doesn't want to be taken off guard if such a tweet ever happens in the days or weeks to come.
But Sami, we're on a knife edge here. Let's be brutally honest about it. We're 1 week in, and I take on board everything you've said. This is one tweet away from being a completely different scenario. But let's just take the president at his word that this could last 4 to 5 weeks. So as it stands, we've got commodities through the roof. We've got insurance costs through the roof. We've got logistics costs through the roof. We've got confidence through the floor. We've got trade through the floor. And we're certainly not going to get interest rate cuts while the inflationary aspect of this needs to be assessed by the central bankers as well. OK, 1 week in, it can all be reversed very quickly. When do we get to the point in terms of time where this really starts to bite? And I'm not just talking about the commodity prices. I'm talking about these massive trade flows that the likes of Maersk are telling us this morning just ain't going to be happening.
Sure. Well, two things. I mean, everything you've said is correct, but the intensity might not be as high. Again, in terms of energy prices, we're not seeing a repeat of 2022. I mean, really, to have a damaging macro and market impact, you need the oil price above 95, 100 maybe. We're clearly not there yet. I mean, for sure, we can get there, but we're not there yet, right? So the impact so far is manageable for the global economy. Then the second element is that some solutions are being put forward. There is obviously rerouting when it comes to energy flows. So potentially you can dampen a little bit the volatility around the oil price. And the third and very important factor, and this is why the data of the day is so important, the difference today from 2022 is that we don't seem to have an over-tightened labor market. So when you think about rate cuts, I'm not sure energy as a source of inflation is enough to remove all the cuts. A tightened labor market would.
Sami, I'm really sorry to butt in, and I've tried to correct myself butting into guests over the years, but I failed many times. I'm failing again today. There ain't any oil on the planet that can replace 20 million barrels. There aren't pipelines coming out the Middle East that can replace 20 million barrels through the Straits of Hormuz, Sami.
Yes, you're right. If this is a question of months and quarters, nothing can replace this. If this is a question of a couple of weeks, potentially you do have a bit of reserves that can allow you to wait and see and avoid. And this is why the price is currently not trading at above $100 for a barrel, right? We're at 85. So for now, we haven't reached levels that would break the back of that expansion. So we're really looking at the two sides of the picture. And you have to replay a movie that we've seen before. In 2022, we had the oil price at 125. We had labor markets that were extremely tight, and central banks were raising rates. Are we really in that situation today? It would be a resounding no on my end. The oil price is at 85. Labor markets are much looser, and hopefully the payrolls will confirm that domestic sources of inflation when it comes to wages are not about to make central banks totally shift their policy.
Sammy, to the point as to whether this is 2022 all over again, and that is one of the big dangling issues now as we look at the duration of this crisis. This was one of the rare years where the market was lower. If you look at the S&P 500 over that year, it was lower. It broke the upward trend that you've seen really for the past 10 years, where every year there's been decent returns on the S&P 500. So if we do see more significant concerns, if there are more reflections that, in fact, this is getting more and more similar to 2022, could there be a better entry point for investors to testing the theory about staying invested?
Well, again, now in 2022, you had the oil price above 100. You had labor markets that were super tight and wages that were going up and central banks that were raising rates. Totally different situation today. So obviously we do expect a different outcome, which means that if we have volatility today and we don't get into the circumstances that we were facing in 22, of course, there is a way of taking advantage of that volatility, repositioning yourselves in the markets that have suffered most, and potentially with volatility being slightly higher, shorting puts with the idea to secure an equity-like coupon is also a strategy that we're trying to put in place.
Sammy, thank you for weighing in this morning. Sammy Chow with us, Chief Economist and CIO Switzerland at Lombard Odier. The American-Israeli war on Iran is, quote, a burden for the European economy. That's according to Bundesbank President Joachim Nagel, who spoke to Annetta on Thursday.
I think definitely this is a very complicated time. I think this war is not helpful. It is a burden for the economy in Germany, in Europe, and I believe for the whole world. So it is dependent on how long this war might last, and I guess it's not this news when I'm saying, well, the best is that this war is over, and then the impact is limited. But I guess it is too early to really come to a conclusion where I can say, well, that what we see that is coming from the Middle East, from this war, is something that is not a concern. At the moment, it is a concern.
Yes, of course, and especially when we look at energy prices, it reminds me actually of the time when we saw the escalation of energy prices when the Russians did start to invade Ukraine, and we all know what it did to inflation. So what's your current take on inflation expectations?
Well, I hear it in these days many times that there is that comparison between what we went through 4 years ago. I think the situation in 2022 in March was a little bit different. When I look back what the gas price did during that time, it was a higher jump. So there are some similarities, but I guess at this time it is a little bit more muted. It's still very severe, very complicated. So it is really pretty much dependent on the fact how long we will be in such an uncertain situation and really how long this war will last at the end.
Yeah, the Vice President of the ECB, Luis de Guindos, you're very familiar with, of course, did just say that the recent developments which we're seeing on the markets, oil price, etc., might warrant a change in monetary policy.
I think at the end we are vigilant, and so we have to take into account what happened and what will happen. So we will come together soon, and then we have to evaluate on all these different developments. And I couldn't agree more what Luis de Guindos said. I think we have to think about scenarios, about how impactful one or the other scenario is, and then we have to come to a conclusion. What does that mean for monetary policy?